My name's Ethan Braid. Today we're going to update our recession watch indicators, and then we're going to assess the likelihood that we might see a recession in the next 12 months. The first indicator that we want to update is the overnight federal funds rate. What I like to point out to people is that over the last 70 years, there have been 10 recessions, and every single recession, the recessions are the gray bands on this graph, every single one has been preceded by federal funds rate tightening. So if we look at these recessions, what you see is that the Fed funds rate is going up and up and up, and then something breaks, we get a recession. Fed funds rate going up and up and up, recession. Fed funds rate going up and up and up, and then it breaks. And here we are again, and again, and again, and again, and again. And here we are in 2008, Fed funds rate going up in recession. And very intriguing that we did have federal funds rate going up and up and up before the recession, government-induced, of 2020. In the last 2 years, the federal funds rate has been brought up dramatically, but no recession yet. Since there hasn't been a recession yet, and we've had substantial Federal Reserve tightening since 2022, there's a lot of talk about a soft landing. Let me show you why I think statistically we're not likely to have a soft landing. When we study the last 70 years of federal funds rate tightening, what becomes apparent is that most of the time when the Federal Reserve has increased the Fed funds rate, we eventually end up in a recession. The time that they engineered a soft landing, in my opinion, is the 1990s, right here. You see the Fed funds rate being taken up and then sideways for a number of years with no immediate recession. And I would say, in my opinion, that this was a soft landing. But what are the odds of achieving a soft landing? 10%? Maybe 20%? So statistically, we have to think that the likelihood of a recession with this magnitude of Fed funds increase or tightening has to be at least 80 to 90%. Now let's take a look at another important indicator, yield curve inversion. Yield curve inversion has preceded each of the last 8 recessions. So over the last 62 years, yield curve inversion has been an accurate indicator of a recession 100% of the time. The inversion that we're looking at here is the spread between the 10-year U.S. Treasury and the 3-month T-bill. Most of the time, the spread between the 10-year U.S. Treasury and 3-month T-bill is positive, and so the curve is not inverted. But during periods of great economic uncertainty, like right now, the 3-month T-bill will yield more than the 10-year U.S. Treasury, and then we'll have a negative spread and the curve will be inverted. Studying this graph, you can clearly see the inversion happening before each recession over the last 62 years, including here we are in 2019, and we inverted just before the government-induced recession in 2020. So we have the largest inversion that anyone alive today has ever seen in their lifetime, and we have significant Fed funds tightening, but no one thinks there's going to be a recession. I just find that really hard to believe. So over the next 12 months, I think it's really likely that we get a recession. Hopefully we don't. But I think we are looking at 80 to maybe 90% odds of a recession in the next 12-month period. The current environment reminds me a lot, unfortunately, of 2008. And let me tell you why. The yield curve inverts typically about 13 months before we get a recession. In 2006, the yield curve inverted, and 23 months later, the recession hit. So right now, we're about 16 months into the inversion, and a lot of people, not everybody, but a lot of people are starting to think there's going to be no recession, there's going to be a soft landing, and it's going to be amazing. And by the way, the stock market keeps going up and signaling maybe there won't be a recession. But again, it sure feels a lot like 2008. I remember what it was like when so many people were caught off guard. Everybody just ignored Bear Stearns' failure in March of 2008. And the good times were just going to keep going and going. But boy, right around election time, it really got difficult for those who remember. So we're not out of the woods yet, is what I'm trying to say. I sure hope we don't get a recession, but it is looking like one could definitely happen within the next 12 months. And that would be normal. Again, go back to 2008. It was a 23-month period from when the inversion happened to when the recession showed up. And as we got closer to that terrible event in the stock market where it just kept going down and down and down, a lot of people are really starting to feel much, much better, kind of like right now. Okay, so just something that you want to be thinking about when managing your portfolio, looking at the risks on the table, and thinking about planning your future. Here's another indicator that we should all be thinking about. What we're looking at here is a graph of the federal funds quantitative easing and tightening program, in particular the mortgage-backed securities holdings at the Federal Reserve Bank. If you look at the holdings, and again, this is a new economic experiment that originated back in the Great Recession back in 2008, where for the first time ever, the Fed started purchasing all kinds of things and building a balance sheet. That was quantitative easing. You can see they bought about $1 trillion of mortgage-backed securities to get us out of the Great Recession. Okay, look what happened starting in 2018. They finally started to perform quantitative tightening, which is reducing credit in the system. And again, I just find it really interesting that here we are tightening, taking liquidity out of the system. And then we get this government-induced recession with COVID in early 2020. It is fascinating. Well, here we are again. Look what's happening. Here is the quantitative tightening going on. And again, this is new stuff. So we're taking money out of the system. We're making credit harder to get. Doesn't it stand to reason that we're probably going to see a slowdown at least, and possibly, quite possibly, very likely a recession? Also, for anybody watching this, if you want to know why your real estate market is absolutely bananas, look at this huge purchase plan of mortgages by the Federal Reserve. Clearly, they overstimulated during the COVID pandemic. They bought way too many mortgage-backed securities, put way too much money out there, and they are the reason why we've had all this inflation. And really, Jerome Powell ought to come out and apologize to the American people. I just find it ironic. This guy is trying to fight the inflation that he caused. When is he going to take responsibility for what he's done to all of us? The last indicator that we're going to look at is the M2 money supply. The M2 money supply is getting more and more attention recently, and rightfully so. And that is because if you look at the last 60 years or so of the money supply, you can see that it always grows. It just goes up and up and up at a pretty measured pace. But then we had COVID, and look at this big jump. And now, for you math people, I put this graph in log scale, okay, to smooth out the impacts of larger and larger numbers. So even adjusted with log scale, we see a pretty large jump in the money supply, the M2 money supply, due to all of the money printing and stimulus that was going on during COVID. Now we're seeing the money supply come down, and people are getting worried, rightfully so. Some very smart people like Nick Gurley at Reventure App, really bright guy. He's been talking about this and many others and saying, look, the money supply is coming down, and wasn't that a contributing factor to the Great Depression? In a deflationary depression, the money supply comes down. So we're seeing it happen right now. The one caveat to this, in my opinion, is that we're also playing games with quantitative easing and quantitative tightening. We're playing financial games that we've just never seen before in the history of the United States. So we don't know exactly what's going to happen. So let's make this simple and just use the Benjamin Franklin decision-making method. Let's add it all up and see which way does the scale tip, and that will tell us what's likely to happen. So number one, we have Fed funds tightening. Fed funds tightening has preceded every recession. Number two, we have an ominous warning from the money supply, which is contracting. Number three, we have quantitative tightening. This is the new economic experiment that the Fed is embarking on, and we don't know exactly what will happen with that, but it's likely that it will precipitate out a recession. And then finally, we have the most reliable indicator of a recession, which is the inverted yield curve, and it's massively inverted, more than anything anyone has ever seen in the last, say, 70, 80 years. No one's ever seen anything like it. So when we add them all up, it's very likely that we're going to get a recession. Now, the timing of the recession is really hard to predict. And no one can do that. Anyone who says, oh, there's going to be recession in April or July, October, whatever, they're just guessing, they don't know. But I think we can be confident in saying that in the next 12, maybe 18 months, what's the likelihood of a recession? And that's where I'm coming to 80 or 90%. I think it's very likely. Picking the exact timing, again, that to me is really, really impossible. But making a statement and saying, well, within the next year and a half, are we going to get a recession? And yes, we're very likely. I think that that's something you can put confidence in and start to plan accordingly with your investment strategy and any new money that you come into. So I hope this video was helpful. I hope it gets you thinking, helps you better analyze your finances, and overall improve your family's financial plan.